Welcome to This Explainer. Today, we're going to completely cut through all the sensationalism and use hard, undeniable data to uncover the actual truth about the UAE real estate market in 2026. I am so incredibly thrilled to take you through this, because honestly, the property market here has done something truly rare this year. It managed to absorb a genuine geopolitical shock, a completely historic wave of new supply, and consistently high interest rates, and yet, it just kept transacting near record levels. So we're going to unpack exactly how that is even possible. Now, if you read the headlines today, you're likely seeing some pretty extreme narratives. It's either a market completely poised to crash or one that's literally going to rise forever. We have all seen those clickbait titles, right? The ones that just give you absolute financial whiplash. But today, we're pushing all that aside. We are going to look at the actual numbers to see what is really happening on the ground. No hype, just the facts, driven purely by the data we have for this year.
So, to demystify these competing narratives, here is exactly how we'll break this down. First, boom or bubble in 2026. Second, a tale of two Emirates. Third, the February geopolitical stress test. Fourth, the Dubai oversupply debate. Fifth, visas, financing, and tokenization. And finally, we'll wrap up with the H2 2026 outlook.
All right, let's jump straight into Section 1, boom or bubble in 2026.
Okay, let's dive into the sheer scale of the current market and the absolute mountain of money flowing through it right now. In just the first half of 2026, Dubai posted a truly staggering AED 286.4 billion in sales across roughly 86,000 transactions. To put that into perspective, that is the second highest half year on record, trailing only behind the absolute peak we saw in 2025. But you know what's really fascinating about this volume? It's how balanced the underlying mechanics are. Off-plan and ready sales were incredibly close to evenly split in value. And listen, this is a massive indicator of market maturity. It means that the larger, higher-value completed properties, the actual homes people are living in, are moving right alongside those brand new developer launches. The market isn't just dominated by speculators flipping paper contracts anymore. End users and long-term investors are deeply, deeply engaged here.
Moving on to Section 2, a tale of two Emirates.
You see, looking at the UAE as a single, homogenous market completely misses the real story of 2026. What we're actually seeing is a very clear decoupling between its two largest markets. Just look at these numbers from April 2026. While Dubai is normalizing at a very healthy 6.1% growth after a historic four-year run, Abu Dhabi has absolutely skyrocketed by 27.8%. So why is this happening? Well, it's because Abu Dhabi is structurally and fundamentally different right now. It's operating with highly limited prime availability and very, very selective new developer launches. Add to that a massive surge from foreign buyers, who, by the way, now make up over 60% of their residential sales. That is a drastic shift from a market that was historically domestically led. Basically, if Dubai is offering investors scale, deep liquidity, and maturity, Abu Dhabi is currently offering incredible momentum and early cycle growth dynamics.
But hey, even when we zoom back into Dubai, the data reveals a highly segmented, two-speed reality. It is just not one uniform market anymore. Prime locations, so think of the ultra-luxury villas on the Palm Jumeirah, Emirates Hills, or the heavily amenitized Dubai Hills estate, these areas just keep gaining serious value because scarcity is a very real factor there. Meanwhile, the broader mid-market, those apartment-led areas, they're starting to cool off and normalize as more supply comes online. And frankly, this is exactly what a healthy real estate cycle looks like. The market isn't cracking under its own weight, it's just maturing, segmenting, and naturally reacting to localized supply and demand.
Which brings us to Section 3, the February geopolitical stress test.
So back during the regional conflict shock in late February 2026, we actually got a genuine real-time stress test for the entire property ecosystem. When regional conflict briefly reached UAE territory, investor sentiment took a massive, immediate hit. The Dubai Financial Market Real Estate Index plummeted 21% in just 2 weeks. Transaction values on the ground fell 51% in the first half of March. Honestly, it looked, for a fleeting moment anyway, like the doomsayers calling for a crash were finally going to be right. But here is the absolutely crucial point. The stock market panicked, right? But the land registry didn't. Despite the massive equity sell-off, physical apartment prices dipped a mere 3% year-on-year during the absolute worst of the panic. Deals just kept quietly closing in the background. In fact, get this, a single luxury residence on the Jumeirah Peninsula sold for AED $422 million. That's roughly $115 million, right in the middle of all this disruption. I guess some people consider geopolitical panics the perfect time to upgrade their view, right? But seriously, this massive divergence between liquid equities and hard assets proved that the real estate fundamentals held incredibly firm under severe pressure.
So why didn't the physical market crash like it did back during the 2009 financial crisis? Well, it's because structural changes implemented over the last 15 years are doing some very real work today as protective buffers. We now have extremely strict escrow protections, ensuring developers cannot misuse buyer funds. RERA regulatory oversight is tighter than it's ever been. And look at the leverage in the system. Bank real estate lending has fallen to roughly 14% of gross loans, but listen, the absolute most important metric is this one. Around 86% of buyers are paying in cash. When a market is that cash-heavy and leverage is that low, the risk of a cascade of panic-driven forced selling is just incredibly low. People don't have to sell if they aren't facing margin calls or crushing mortgage resets. Let's move on to Section 4, the Dubai oversupply debate. All right, this brings us to the elephant in the room, and easily the most heavily debated topic among analysts. Is Dubai heading for a supply-driven correction? Understanding the gap between expectations and reality here is literally the single most useful thing you can do as an investor this year. You are inevitably going to see scary headlines warning of 120,000 to 160,000 units flooding the market in 2026. But listen, that registered pipeline completely ignores historical delay rates. Developers pace their builds based on real-world supply chain realities, contractor availability, and strategic market absorption. So even with completion rates improving recently to about 64%, actual post-delay deliveries are projected to be around 55,000 units. Now, yes, that is still above historical averages, and it absolutely will put rental pressure on dense mid-market areas. But 55,000 is a very manageable number. It is nowhere near the cataclysmic flood that the headline numbers are trying to suggest. Next up, Section 5, visas, financing, and tokenization.
Beyond just the concrete and steel hitting the market, legislative and technological shifts are quietly establishing entirely new foundations for long-term demand. Let's start with the policy side. The February 2026 changes made the UAE Golden Visa significantly easier to obtain. You still need an AED 2 million property valuation, but you know that old requirement to pay 50% of it upfront? Completely gone. Now mortgage buyers and off-plan investors qualify immediately, based purely on the total value of the title deed. With over 250,000 golden visas issued in Dubai alone since 2021, this creates a massive, durable pipeline of long-term residents. These are not transient workers. They are embedded residents buying homes, enrolling their kids in schools, and essentially underpinning market demand for decades to come.
And then, of course, there's the tech. Dubai is actively tackling real estate's oldest and most stubborn problem, illiquidity. In February, the Dubai Land Department launched Phase 2 of its tokenization framework. Think of it like buying digital shares in a physical building. And this isn't just a pilot program anymore. It is a live, regulated secondary market. You can now trade tokens tied to physical Dubai properties starting at just AED 2,000. That drastically lowers the barrier to entry for retail investors all over the globe. Their stated goal is to digitize AED 60 billion of the real estate market by 2033. This is a massive structural shift that will completely change how and how fast global capital flows into the city.
Finally, Section 6, the H2 2026 Outlook.
So what should you actually take away from all these numbers, policies, and tech innovations as we look toward the second half of 2026? Well, the overarching thesis from all the aggregate data is this. We're seeing a deceleration, not a reversal. The days of double-digit growth across every single neighborhood, those are over. Growth is slowing, and submarkets are heavily diverging based on quality and scarcity. We really have to stop treating UAE real estate as one single entity. But ultimately, the market is absorbing geopolitical shocks and a healthy wave of new supply remarkably well. And that is almost entirely thanks to those cash-heavy, low-leverage structural buffers we discussed earlier. So I'll leave you with this thought to ponder. As you consider your next move, ask yourself, do the traditional ways of measuring a property bubble even apply anymore to a market that is fundamentally rewriting its own rules? Between the influx of golden visa residents and the creation of tokenized, highly liquid real estate assets, the UAE isn't just surviving the traditional property cycle, it might be evolving it entirely. Thank you so much for joining me on this explainer, and I highly encourage you to go dig into these numbers for yourself.